Thanks everyone. Hi, good morning everyone. Shantanu Gupta, partner at Khaitan and Company, part of the M&A and private equity practice area of the firm. I'm a transactional lawyer specializing in energy transition and infrastructure space. Absolute pleasure to welcome you all on this session on cross-border capital flows, how LPs are reshaping Asian allocations with India at the center. To unpack this, I'm joined by an exceptional panel. We're shaping this conversation on the ground. Now let's start with the big picture first and some data and statistics. Over the last few years, we've witnessed a remarkable realignment of global private capital flows. If you think 5 to 7 years back, most investors, what I would call, had an allocation anxiety. They had the will to invest, but not the confidence that the investment would translate into meaningful and realizable outcomes. Now, things have changed substantially. The story is very different. We're in a phase of deployment confidence. And of course, a large part of that has been driven by the track record of exits, a mature fund ecosystem, policy stability, digital adoption, and of course, the climate transition. Interestingly, Asia is projected to account for nearly 30% of the global private equity by 2030, which will be led by India and the Southeast Asia. Now, Craig, I'll start with you. Now, from a DFI perspective, how do you see LP capital flows across Asia evolving in the recent years? And secondly, when you look across Asia, where does India fit into that, which makes it as the most investable market amongst the global LPs today?
Yeah, I think from the DFI perspective, we sort of, I guess, invest across emerging markets. So we have the choices of Latin America, Africa, Asia. And look, Asia has been, in particular the last sort of 5, 8 years, the one where we can sort of get more predictable returns. There is a big impact case for investing into it. But a lot of our bread and butter is still sort of focusing sort of the African market. So we see this being quite stable. In that, we've also come much more focused. So where is our capital actually needed? You get a place like India where there's lots of capital coming in here. You're seeing sort of record capital raising by GPs, sort of good investment flow happening as well. And so I think over time, we've sort of started to focus on the climate side, inclusion side. So it's more where can our capital have an impact, what we've started to focus on in that. Now, I think generally speaking, Asia is where a lot of the capital, not just from DFIs, but generally is coming to, because there's sort of good fundamentals there. There's strong growth, there's the geopolitical side, the supply chain moving. And in the West, also there's slower growth there. So we are seeing generally capital coming here. And from our perspective, it's sort of where can our capital have that biggest impact. India, I'd say for a long time, people were a bit hesitant of coming into India. There were lots of challenges. Is the returns going to come there? The government support and the regulatory reforms are clearly coming through there, which is providing more comfort there. We sort of have seen that a different take from investors generally looking at the India thing. They're interested to understand it. Some are still on the fence watching it, and also they're investing into larger funds as well. Where we're seeing a bit of a gap is sort of it's still challenging to raise for mid-cap, large-cap, mid and small-cap type funds, and in particular thematic funds. So in the climate space, be it inclusion, it still is a difficult fundraising space there, and that's where sort of DFIs have a role to play on the India side as well. So we are seeing more appetite to do more in Asia generally. India is a big part of that, and I think just the foundations, the regulatory support, the domestic demand, the infrastructure is driving a lot of that. And hopefully over the next 5, 10 years, there'll be more commercial capital coming into particularly spaces like green investing as well.
Interesting. And Diane, if I can bring you in, do you see this shift as structural or cyclical?
Yeah. Proparco has always been an African DFI, I would say. 50% of our allocation is going to Africa. It's a big mandate for us. But I think since 10 years, we can really see the shift to Asia and more particularly to India, for sure. I think for me, three main drivers for why Asia. Since I'm in India and covering the South Asia market, we can really see that India, more and more investors are attracted by Asia. Why? The first point will be really the sophistication of the FI market in India. You have a lot of investors, I would say funds, banks, NBFIs, of course, receiving money for Asia, but all those institutions are also sending capital out in Asia and in other parts of the world, and specifically Africa with this cross-knowledge and cross-cutting innovation. So I think this is something very, very interesting for a DFI like Proparco, working in India, working in Asia, to see this new, I would say, new normal, which is shaping today the capital world, and how a DFI like Proparco should position ourselves in the new partnerships between Asia and the rest of the world. And I think that the second main point will be really the money needed for capital and capital needed for climate and energy transition. Asia is one of the biggest emitter in the world, but also is the place where you have the most innovation and the most, I would say, climate projects coming up. A lot of opportunity that we can see in green investment, wind, solar, battery storage. So in the sense, I think Asia is really the place to be for DFIs and for partners who really want to flow the capital in a right manner in order to support planet and people. This is exactly, I would say, the mandate of Proparco in the region, and how we see India. And I think since 4 years, India is a bit a place to be for Proparco. Why? Naturally, a lot of innovation taking place. We can really find leaders on each niche market. Raj can attest that. And I think the technology, fintech, the digital innovation for more inclusion is really taking place in India, and it's really something very interesting. The regulatory and the policy approach, Proparco is super focused on circular economy since 2-3 years, and what's happening in the EPR is also something very much interesting, and you can only see it in India. So Asia, of course, and India has a very special place for Proparco in the region.
Thanks for that, interesting. Kazushige, I'll come to you next. Interestingly, Craig mentioned about some investors still being on the fence. Now, Japanese investor participation has been relatively low, I must say. We see a lot more participation from the strategic investors and not so much from Japanese LPs. Would you say Japanese LPs, are they still risk-averse about India? Or do you think that the perception is changing in this entire context of, say, decarbonization, energy security, and the like?
Yes. Yes. So I'm basically talking about the Japanese financial investors. And so basically people know Japanese financial investors are very conservative people. And that means they are taking a lot of time to make investment. And so they are a little bit, say, cautious about the risk. And it's because of that, say, investors typically allocate, say, 70% of their portfolio into US market, and followed by European investment, then Asia come last. So that's a typical allocation. But because of, say, geopolitical situation, including US situation, so they are wondering, say, how they should, say, change the, say, asset allocation or diversification. And then looking at the global market, so now I think India is very interesting market for Japanese investors. There are a couple of reasons. Firstly, Japan and India has very good relationship on the government level, and then it affects to the more DFI investment in India. And then Japanese strategic companies getting more active in India, so that's a good thing. And finally, Japanese financial investor, because they haven't know much about India. Actually, I've been investing in India for 20 years, but I've been very alone. But now we have lots of friends who are interested in India now. And so level of the understanding in India is getting better now, and gradually they are investing more into Indian market. So that's the general part. And then for Japanese investors, climate or net zero is very important agenda as an institution. And then they are very active in Japan, and also they try to expand more investment for this purpose in global market. So India looks very interesting target because it's growing market, and also it's very important market for impact. So that's why Japanese investor looking at this market very positively now.
Interesting. Okay, so now I'll shift the conversation to the LP returns expectations. Now, LP priorities have now evolved from just financial IRR to, cover even climate alignment, governance, and measurable impact. But the fact of the matter is, returns still matter. Now, the question is, how are LPs or investors like yourselves balancing both? Now, Raj, my question is to you. Now, GF has been investing in India's climate and energy transition space for years. You're one of the most active investors in that space. You being on the GP side, how are LP expectations evolving, on these aspects in terms of returns, governance, sustainability outcome? Where's the change?
Thank you. No, I think it's been for GEF, this has been a 17-year journey investing in climate in India. And I think maybe to start off, it's really a privilege to be on this panel. I think having worked with many of all these organizations on the panel who are really committed investors in this country, I think that's very important. 20 years, and I think with BI, Proparco, Blue Earth, I mean, collectively it's 100 years of investment cumulatively in India, which is very important. So I'll address the 3 points, Shashank. One is, let's define impact. I think when we look at impact, we have done about 21 or so transactions in India over the last 16 years. I think I look at impact in 3 ways. One is, of course, the mitigation. I think Dr. Nageswaran spoke about. It's a very interesting, mitigation is something people immediately understand. You are creating impact by reducing carbon. These are the energy. Renewable energy is a very great sector that directly reduces carbon impact intensity. Transportation, India is one of the fastest growing electric vehicle market. Industrial decarbonization, manufacturing, building construction is very funny. I'm talking about some new sectors which some of the audience may not immediately correlate to climate. So construction is a space. I read somewhere India adds a city the size of New York every 5 years, just cumulative construction activity. So I think these are very, very hardcore climate mitigation impact sectors. I think the previous Dr. Nageswaran spoke about adaptation. I would say 10 years ago, this theme didn't exist. Today, there are 2 sectors which are probably the most vibrant, which are food agri, is one of the most adaptation, consistent, correlative sectors. So we have been very active in looking at ways to formalize the farming and food agri sector, by financing, by more efficient storage and wastage. 90% of the food issues are related to wastage and storage. So we are really addressing that. The other sector we like in the adaptation is water, recycling. So that's one of, again, another sector which gets a very little airtime. So India today, for what I know, 18% of world population has access to less than 4% of groundwater, right? I would say the water issue is more acute than even energy, in my opinion. The third impact, I think Craig spoke to it and so did Diane, is, it's not just climate, but how does that correlate to more developmental impact? So that's very important from an LP expectations. We are talking about, green jobs. It's a growing country. You need, it's not just about reducing pollution, but creating jobs. Potentially green jobs is good. Gender is a very, very popular topic. I think there are frameworks which help see how to improve the gender quotient in manufacturing, for example, from low single digits to 30%. So that's something we keep an eye on. So a lot of topics. So moving on to returns, I fully agree. I think one consistent theme we have heard as a GP, as an investor, all this is good, but it has to be impact at scale with returns. Because honestly, without returns, I think it's very important. It's not about expectation. That's what makes the industry thrive. The recyclability of capital is very important from an LP perspective. And I think, it should at least beat the passive index returns. If you are an investor globally, it's not just you are investing in India because there are no other markets, right? There are so many other markets. You have to generate returns that at least beat, from a risk-adjusted basis, the other passive index returns. So sometime in the high teens and mid-20s is kind of a baseline return expectation the LPs have, and I think justifiably so. Last point, not to take too much time here, is governance. I think I was at some conference and there was some kind of a poll taken. What is the number one value creation number one variable that leads to value creation, especially in emerging markets? And surprisingly, the number one was governance. So honestly, there's a high correlation between companies which have a high governance risk management committee. Like for example, we have never done a deal without having a board seat. We have never done a transaction where the risk management committee, ESG committee, is not put post-investment. And honestly, it's not just a feel-good factor because there is absolutely a direct correlation to returns tied to governance.
No, absolutely. Even I can tell you in the last 10 years, whenever we've drafted these shareholder agreements, these committees earlier were never discussed. Now it's actually at the forefront. There's a lot of discussion what happens in risk management committee, your ESG committee, what will happen, what will be the role played by it, etc., what will be the composition, and so on and so forth. I think that's changed tremendously. Rita, I think my question's to you next. Raj has answered from a GP perspective, but I wanted something from you from a LP perspective. Now you're an impact investor. Impact investor like yourselves focus more on quote unquote measurable impact metrics, right? So now what do impact investors like you want or expect from India-focused funds in terms of hard data and forward-looking impact plans, as opposed to, a few years back it was just ESG reporting which was focused on, but clearly it's evolved, the expectations evolved. Now, how do you see that changing? How is it different from what it was a few years earlier?
Yeah, thanks for the question. And as an impact LP, we still prioritize returns, because without returns, like Raj mentioned, it's not sustainable to keep backing the economy. And India, for us, is a core strategic deployment market. We've been active in India for more than 10 years now, investing across different impact verticals by our definition. And to elaborate on the point Raj mentioned, returns, it's not just the headline IRRs that we're chasing. It's real concrete cash return, DPI. I think the exit market, a lot of people can relate to me. The past few years has been challenging, especially over 2024. Everyone faced exit challenges. And to prove that as a GP, you can exit in this environment, you can generate cash back to investors. I think that gives a lot of comfort that they keep on backing this economy. And traditional return routes, such as IPO, there's a great IPO market in India. I think most people can agree. Strategic M&A, financial sponsor exit routes, those are also very active in India. So if GPs can generate returns by exit, that's great. But if for certain reasons those are not available at that moment when you need to generate returns back to LPs, show that you are creative in how you structure deals, how you make it happen for LPs to gain comfort, to recommit. So that's one point on return. And I can wholeheartedly agree on the governance part. As an LP, with our foot on the ground, we don't have local presence. My colleague and I are in and out of India, let's say on average once a month. But because we don't have local presence, so we rely a lot on our trusted partners on the crowd. And without concrete governance approaches, it would be tough for us to back those GPs. So without a board seat, let's say that's a basic requirement. It's not like nice to have anymore. That's a prerequisite. And risk committees, remuneration committees to make sure everyone's aligned, because we're too far removed from the markets. And the last one on impact, so this is the focus point. It's not just high-level ESG narrative that could buy us anymore. Now we need a concrete action plan by the time you sign an SHA, a legal documentation to invest in certain company. There must be a concrete environmental, social action plan. And then there must be monitoring key KPI that can be verifiable, that can be validated by third party as well. The headline ESG narratives alone doesn't buy us anymore.
Interesting. Then to the DFI folks, Craig or Diane, sorry, either of you can answer this one. Now, when it comes to due diligence carried out by LPs with respect to the climate over the last few years, what are LPs now asking for that they weren't asking for earlier? What has changed?
We are painful. Raj knows that. Indeed, our due diligence are very much comprehensive on the ESG side, on the climate side. But coming back for myself, 8 years in Africa, what I can see here, as a DFI, we have a lot of learn on what funds are doing already and partners are doing. So here we need really to focus on two categories of actors. If you take corporates, and great example, we are working with Gravita. Gravita is one of the lead company based in Jaipur in the lead battery manufacturing. So why Proparco? It took almost 8 months to close the deal. Super painful. First time that we are touching the recycling sector. But still, they really wanted to work with us. Why? Two reasons. Proparco is coming with costly money, but a lot of knowledge on the ESAP. So we really pushed Gravita to put in place a very comprehensive environmental, social, and action plan. So thanks this ESAP that they are rolling up, they are able to gain markets in Africa. So Proparco financing was to implement Gravita factories in Ghana and Senegal. So compared to local actors, Gravita was super advanced on all these social topics. So this is clearly one of the value added that we can bring to corporates, family-owned business, doing great jobs on sustainability, but want to scale up more in other countries in Africa. And here, they need to be very much focused on sustainability and governance. And then we have the next category of actors, which are PE funds and financial actors. And here, to be very transparent with you, they are super sophisticated. Good example, it's not Raj is there, but I think 2 years ago, I took my climate colleague to talk to Raj colleagues on ESG, and he was impressed. And he was saying, oh my God, we should take example from them to our disclosure information. So I think we really need to identify these two kind of actors, and each time it's maybe not on the ESAP, more on the governance. These are the value added that we can bring.
I think to add to that, I think there's a couple of those. One is sort of the area, and this is looking at the GP around sort of the greenwashing. So really, how are we making sure that the GP is aligned and interested? What we've seen across the globe is sort of when the new theme comes up, it could be ESG, it was in the past, it's now climate finance in the past. People sort of, it's difficult to raise money, so people are shifting to try to raise it. So how aligned are they? Who do they have in the team who has climate experience. What's the IC composition look like? What does the advisory board look like? How are they going to measure the climate impact? What are they looking for in that? How does it fit into their actual process there? And how are they going to deliver return as well? We have no compromise on return while we're looking at impact. It's harder, but we have no compromise there. So a lot of it is around sort of that greenwashing part. The other part is sort of how can you help support the potential companies you're investing into in having a more positive impact on the environment. And so what value add can you have, the action plan thesis as well there. So these areas are very important for us when we're sort of assessing the manager and what they're actually doing there. And also there is sort of various taxonomies out there. So which one are they sort of applying there to make sure that they are sort of continuously learning there? And it has been a learning journey for us as well. I think all DFIs are learning how to invest into climate, how to work towards that net zero as we go along there. So it's also cross-sharing sort of our learnings, learning from the GP, but also putting in touch with other GPs to cross-learn around that. So yes, it is a big ask because the license to operate needs us to actually do that. But hopefully in the end, it means we won't take that sort of that greenwashing risk, and also hopefully we can make a strong return from this. Because if you don't make a strong return, the commercial capital, which isn't yet flooding in, will not actually come into this space.
I think to Diane's point, I must say, having dealt across with DFIs, deal takes substantially longer to close, but the good part is, you guys are the anchor funds, bring in the catalytic capital. Once you come in, it gives a comfort to a lot more other investors thinking that, you've set the gold standard there, right? So it gets easier to get them on the cap table once because you've done that exercise for the benefit, for their benefit. So fair enough. Then moving on, I think I just want to double click on India now specifically. The fact is that, and coupled with energy transition, I think one of the biggest macro drivers for LP allocation in India has also been India's thematic depth in energy transition, right? So these are not just isolated opportunities, but full value chains. You have utility scale renewables, you have storage, you have e-mobility, you have decarbonization, and climate financing, as Craig spoke about. Now, Craig, going back to you again, which of the India's transition value chain do you think is the most scalable in terms of deployment? Be it generation, storage, e-mobility, industrial decarbonization. Where is the action?
I think all of them have the action. I would agree there's a lot of opportunity there. But I think, look, India has lots of engineers, got lots of manufacturing capabilities, so the supply chains, all these things can really play a big role there. So it's still fairly nascent. There is a need for growth capital there, but if these things can scale up, then there'll be larger opportunity for the buyout funds, etc. there as well, which will improve the exit side. So I think that that space on the supply chains, and be it on the renewable side, the EV segments, is quite exciting.
And Raj, are you seeing the same thematic depth? Because what GF is known for is, considering mid-market climate themes. That's where you primarily operate. Or are you still seeing that LPs tend to prefer large-scale infrastructure projects?
I think these are two different segments, and I think it's a self-selection. There are investors who prefer the steady returns of the infra, but we are clearly on the mid-market growth. I'm biased, but clearly I think if you look at alpha generation, what we have seen, I think Rita mentioned something phenomenal has happened in India over the last 3 years, and I think one part is the whole capital markets. So there's been about 500 IPOs that have happened, which has unlocked upwards of $30 billion of investor liquidity. But if you see the companies that have benefited are largely the mid-market companies which are trying to scale up to the next level, and they say, look, we can raise another round of private equity, or I can access the public market. So that's been a phenomenal, and I think that's the big part of energy transition. A lot of the successful companies have really found favor with the capital markets. And I think last point on that is, maybe I can save it for the later, but India, today the liquidity market in India is beyond capital markets. It's funny, out of the 11 exits we have had, 3 of them actually we were able to exit not to another PE fund, not through capital markets, not through strategic, but to just a clutch of domestic Indian family offices, some of whom actually manage more capital than private equity funds. So I think India as a secular region to provide diversity of exits for energy transition companies and other climate themes has never been more buoyant than it is in the last 3 years that I've seen.
Okay.
If I may add a point here. So when local domestic LPs, family offices, like you say, back the exits of these companies, it gives a lot of confidence for international investors as well. Because if the local guys are so confident on these opportunities, then the international guys like us can also tap into that and can also follow the trend.
Interesting. And I'll flip the question now, and maybe Kazushige, you can answer that. Is there a part of the transition value chain which you believe still needs more de-risking than the others before LPs start investing?
Sorry, yeah, could you repeat the question?
Sorry, I'm saying, is there a part of the transition value chain where you believe it's still at a nascent stage, so it still requires a bit of de-risking before LPs start coming in?
It's very difficult. So basically, as I say, investor of say private equity or venture capital, basically say we like, firstly say we like a little more asset right business, and then look at the value chain if say business is very asset heavy business. So probably it's a more say investment for infrastructure type investor. So we are focused on different type of business, and then it's a good or not. But we are in looking at India, we are a little more interested in deep tech opportunities, because we are seeing a little more new technology, new type of business, and which can solve kind of bottleneck of say value chain. So that might be an interesting target for us.
Okay. Thanks. Now let's talk about not how much the LPs want to invest, but how LPs want to invest. Now, in the last 4 or 5 years, everyone can see co-investments have exploded, right? So, especially in energy transition, where LPs want more transparency, fee-light exposure and control. Rita, a question for you. You look at this space very well. So we're seeing a rise in co-investment models, especially in the climate infrastructure space. How is that reshaping the entire GP-LP, collaboration?
Yep. So co-investment programs are not only a way for us to achieve more fee efficiency, but it's also a way for us to learn more about the market, the target, and the GP itself. No matter how much diligence you do, I think a lot of LPs can agree that going side by side with the GP through the entire diligence process, the entire co-underwrite, that gives so much insight into how GPs structure deals, underwrite deals, and how they view their investment judgment as well. So co-investment for us is key to look into diligencing, especially new relationships. Existing relationships that we've been working with for many years, also developed, initiated through co-investment, that gives comfort. But especially for new relationships, that just gives so much value into relationship building. And of course, you may appreciate during deal execution process, you work long hours, you do this and that together side by side. That's just how you build up the partnership approach.
Okay. Then I have a quick rapid fire to all the panelists. And this is one of my favorite questions. If you had to bet on one energy transition subsector for the next 5 years, what would that be? Craig, probably start with you.
In transition subsector. I would say one of the EV subsectors. So something in that space where it's a China plus one story, bringing something to India where India can actually add that value there. I'd say it's one of those segments. I don't have a specific one, but I think that segment there.
One topic for me will be more adaptation finance. I think this will be the next bet, and we need more catalytic capital, and here DFIs and multilaterals are a big role to play in Asia on adaptation finance. And more talking about the subsector, I would say the solar PV manufacturing is for me the next classic solar project where there is, we still need confidence from DFIs, from funds to back this sector because we have a lot of queries on supply chain and everything. And here there is already a lot of interesting examples, Premier, BII-backed, Renew Power, and I think soon we will disclose also one transaction validated by our board, and I think this will be the subsector where we need to be more active.
Yeah, for me, same. So I more interested in EV. Mobility is very important segment, and looking at potential of Indian market, I bet on EV.
I think all of the above, but to add one from my side, I would say I think we are seeing some unique challenges. I think India is now getting resilient on adding more energy, the grid, but the big challenge now is on the storage. So one of the sectors we are keeping an eye out is the battery energy, the BESS, the battery energy storage systems, and I think that's already happening. Now every bid that is being put out by private or public has a component of at least 2 to 4 hours of the power needs to be provided with the batteries, because that's the missing link. That's what makes the renewable more attractive. That's what makes the grid more stable. So it's an evolving space, and I think we are still not fully there in terms of technology for the prices to come down. But in the next 5 years, I'll be surprised if we don't find at least 1 or 2 good bets in there.
For me, I don't put all my eggs in one basket. I pick 2. First of all is the mobility, also addressing social mobility, and that helps a lot with improving the livelihood of the population as well, so that's one. The second one, I think India is really big on agriculture. So if there are solutions that address the need, or let's say adjust behaviors of farmers in a way that can mitigate or cut down on the emission, I think that could be a good bet as well. And from the companies presented around in the conference hall, I have seen a few solutions towards addressing the need of farmers or working with them to cut down on emission. And I'm very positively surprised, but also really happy to see that development.
Interesting.
If I may, this TV is completely stressful. So I think the coming 5 years, the air pollution in Delhi can be also a good focus, and the stuff that we are doing with the farmers.
Interesting, no one mentioned green hydrogen and green ammonia. Every conference I go to, I attended one in Singapore last year, and everyone's like, where's the future headed for green hydrogen, green ammonia? But interesting, none of you guys included that in your list. Okay, I think we're about time. I think we just have a few minutes. So just to wrap up, I think we've had a powerful cross-section of perspectives. We've heard from the DFIs on the panel, anchoring sustainability capital. We have Japanese and investor looking at Asia with renewed confidence, and of course, we have GPs and impact funds experimenting with new investment models. To summarize, I think there are 3 takeaways. I think one is global LPs are relocating towards India, not just for growth, but also where energy transition deployment is scalable and investable. I think that's important. Second, we're no longer just an emerging market satellite. We are a core climate allocation market. Policy stability is there. There's thematic depth. And as you mentioned, credible exit stories as well. And the last is the future of LP capital flows. The way I see it, it'll be shaped by partnership models. We'll see more of perhaps co-investments, blended finance, LP-LP collaborations that accelerate probably India's energy transition story. So on that note, a very big thank you to all of our panelists for joining us for this insightful discussion and to the audience for joining us this morning.